Intel is down almost 12% today after reporting its earnings in the pre-market. Is it undervalued? Is this now a good opportunity to buy Intel Corporation? As always, we'll look at the historical performance of the company. We'll see how their total revenues have progressed over the last 5 years, as well as their bottom line net income. We'll have a quick update on the health of this company, total cash versus total debt. We'll also compare how they have performed versus some of their competitors over the last 5 years. We'll talk about some bullish signals that we're seeing with insider buyings from the CEO. We'll also take a look at their dividend safety and some financial metrics. As always, we will have a quick look at the institutions, whether or not they are buying or selling, and we will run through their earnings report at a very high level, and we will put them through the valuation model, getting to our intrinsic value, finding our acceptable buy price given that investor margin of safety, and as always, we'll see what Wall Street are forecasting over the next 12 months. Let's jump straight into their earnings report now. The headline sees that Intel stock sinks 10% in the pre-market. Now the markets are open, it is down around 12%, and one of the main reasons for this is that their 2024 outlook has come up short. So let's actually take a look at the earnings and see on the top line how they performed. Well, EPS 54 cents adjusted versus 45, so they actually beat on EPS, which is positive. Revenue, another beat, 15.4 billion versus 15.15 expected. So we can see in actual fact they did do a double beat. Now, yes, they had a double beat, but what are the reasons why we are seeing this drop? Well, what we can see for the first quarter of 2024, they are expecting earnings per share of 13 cents on between 12 to 13 billion of sales. Whereas what we can see, the expectations were 33 pence per share on 14.15 billion of revenue. So they are looking at some very weak guidance in anticipation of what Wall Street had expected. So that is very poor. And what we can see from the CEO, Pat Gelsinger, saying that overall sales will take a hit because of their weakness in their subsidiaries, including Mobileye and their programmable chip unit. So lots of things just to dissect here. We can see whilst they did do a double beat, and this is good to understand for other companies when they do report, just because a company double beats, it doesn't mean the share price will go up. You always need to look at the forward guidance. Now, Intel over the last year, they are up around 48%. They are still trading after their drop in the mid to upper end of the 52-week range with a yield of just over 1% and a fairly high forward PE. Now, over the last 10 years, we can see their performance. You would be up 78%, and remember, this doesn't include those dividends reinvested, but we do see their all-time highs in around 2021, where they did hit around that $70 mark, in fact, just under. So let's take a look at their top-line revenue. What are we seeing? Well, 72 billion reported in 2019, 54 billion in 2023, so they have got their annual accounts. Now, that is exactly what we don't want to see. Their top line has in fact decreased, and we can see though they have increased to 2021 before decreasing down to 2022 and 2023. Now, when we compare that to their bottom line net income, 21 billion reported in 2019, 1.7 billion reported in 2023. Again, we can see very surprisingly a decrease significantly year on year to Intel's bottom line as well as their top line. Now, when we take a look at their health, we have a quick look of that total cash versus total debt. We can see their cash has in fact gone up 13 billion in 2019 to around 25 billion from their latest quarterly report. And what we want to compare that very quickly to their total debt numerically and directionally. We can see that has also gone up 29 billion in 2019, 49 billion in 2023, their latest report. So there are some causes for concerns, but we can take a look at that net debt to EBITDA metric because cash as well as total debt have been increasing over the period. Now, in terms of looking at some comparable companies in the semiconductor industry, we have Qualcomm, TXN, Advanced Micro Devices, and a few known others. Now, over the last year, Intel is actually performed very well, up 50%, including those dividends reinvested. In fact, the second best performing. And when we extend that to the last 5 years, we can in actual fact see they are the worst performing, and that is no surprise given their price did heavily drop when we looked at the last 10 years. Now, as we always say, past performance is never really an indicator of future performance, but it's always good just to have as one layer of the research. Now, Insider buying, insider selling. Well, for Intel, we have looked over the last 3 months, no insider selling, and in fact, insider buying is a much better metric to understand about the company because this is a very bullish signal. What it means is that the insiders, and we can see here both CEO and director, believe that the share price over time for Intel will increase. Now, we can see the essential CEO, he did buy around 7,000 shares in November. Now, this was around when it was trading at $37 and he spent around $250,000 worth. The director bought a few days later, in fact, a significant number of shares and spent around $2.5 million at slightly higher than the CEO. Now, as I mentioned, this is a bullish signal. They do typically buy because they believe the share price will go higher. Now, in terms of institutional ownership, 61% as we can see here, $8.5 billion worth of sales by these institutions over the last 12 months. A lot more buying, in fact more than double over the same time period. And when we analyze it Q1 to Q4 of 2023, every single quarter there has been a lot more buying by the institutions than selling, with a significant buy in Q2. Now, again, similar to when we look at other metrics, this isn't something that we should indicate as a buy or sell just because institutions are buying, or even if they were selling, we should be selling. We always need to do our own due diligence, but it is interesting to know whether or not these institutions are also buying or selling these companies. Dividend safety score sits at 60, it is borderline safe. Market cap 209 billion, a mega cap company. Now, in terms of those key recessionary metrics, well, they maintained the dividend during the last recession. Below average growth, remember S&P 500 growth was negative 12%, and they did slightly outperform the S&P with a negative 49% return versus the S&P's negative 55%. Everyone who has been holding Intel over the last few years will remember that very sour dividend cut that happened last February, in fact nearly a year ago, negative 66%. But that does mean we are expecting a dividend increase over the next few weeks, 6% on average over the last 5 years, and even with that dividend cut in play, over the last 20 years that dividend has increased 16% year on year. And no surprise, 0 years of consecutive increases. Hopefully this year will be the first increase since that dividend cut. Now, dividend yield theory says the company is undervalued when the current yield sits above the 5-year average. So we have our first sign of overvaluation as that yield sits below 1.14 versus 2.5. Likewise on the forward PE, 33 versus the 5-year average of 13. But bear in mind, we don't look at any of these models in isolation and we will draw conclusions towards the end. And we can see Intel is also sitting higher than the sector PE for information technology at around 27. Now, let's look at the free cash flow payout. As always, we do prefer to ignore earnings. It is susceptible to manipulation by management through accounting. Personally, below 60% because it gives me faith management can offer those double-digit increases. Semiconductors, well, you can bring that down to 50% if you do want to be industry specific. Now, up to 2021, we can see it was looking fairly strong around that 60% or lower. 2022, we did see that dividend cut, but we also note when we will take a look at the free cash flow per share, they have had negative free cash flow and hence why we see that negative ratio. Now, this isn't great news. It has gone from $2.10 to $2.25 in 2021 before 2 years of negative growth. So it is something just to consider and something to keep an eye on. You do want to be investing in a company that is producing positive free cash flow per share. So again, this in my opinion is a red flag indicator. Sales growth, as we noted earlier, a minimum 3 to 7% to signal steady moderate growth. The last 2 years have looked very weak for Intel. Makes sense given how hard that share price was hit, and I believe it was trading in the low 20s at some point last year. Total sales then, in terms of looking at the last 10 years, it hasn't really moved from 56 billion to 54 billion, which when you include inflation in real terms, their top line has been decreasing. One thing that Intel do is returning excess cash to investor pockets. They do share buybacks, 5.06 billion to 4.21, so it is a positive thing to note about this company. In terms of the ROIC, now as I always mention, 10% or more, this gives me personal faith management are able to effectively allocate their capital. What we can see for Intel, up to 2021, it was looking positive. The last 2 years, for me personally, I will already tell you this isn't a company I will be looking to invest in. I can't get behind a company where the ROIC is at 0%. Now, in terms of the margins, well, this is something that you do want at least a minimum of 16%. The last 2 years, Well, 2022 at 4%, 2023 at 0% is essentially saying that they are making no profit. The bottom line is nil. This is a bit of a worry in my personal opinion. If you are a shareholder or are interested, this is something I would take further and especially look at forward guidance in some significant detail. And it comes as no surprise given their free cash flow per share is negative. The last 2 years, the free cash flow margin has also been negative. Now, net debt to EBITDA, earnings before interest, tax, depreciation, amortization, shows us two things. Remember, the balance sheet strength as well as dividend safety. This shows us the number of years it would take Intel to pay off all of their debt net of cash on hand. 1.94, now it is above that 1.5 maximum we like to see for the semiconductor industry, but 2024 is expected to come down to 1.42, so it isn't something that is a massive worry or a red flag indicator as long as management continue to stay on target with that. Now let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now, before we just jump into the valuation, just to let you know that we have released the second weekly newsletter. It is completely free. If you do want to read about it, do click on that pinned comment below. It's completely free, and we are discussing an undervalued company with some strong upside, running through the metrics and discussing why exactly we like this company. So let's jump into the valuation model. Now, what we will say is the first two models aren't relevant for Intel, but this is purely based on the fact that the earnings per share for the trailing 12 months is incredibly low, and it is a one-off for Intel, so it will massively skew the data. So the first model, whilst this would be the second one we would use, the first model we are using is the dividend discount model. Now, it should come as no surprise that we do see that dividend cut around 65%, and the average growth therefore over the period is negative 9%. Forward looking, we've gone for around 6% from the data we described earlier. That is pretty much their average 5-year increase. Now, what this gives is an intrinsic value of $28. Now, this is significantly below the market value, and we have our first signal of overvaluation. We then move on to the DCF model with the free cash flow year on year. We have the average growth rate forward looking at 8%. With that discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding. We have that intrinsic value, so we have a signal of undervaluation. Now, the intrinsic value in today's episode for Intel is just the average of these two models, so just understand that, and it comes to around $41. As always, if you do want to grab a copy of the model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or those on your watch list, then do click on that pinned comment below and grab a copy. So typically we use a 10% margin of safety if we believe it meets 3 criteria: wide moat, strong financial metrics, good forward-looking data. For Intel, we can see it doesn't even warrant a 5% margin of safety. So right now we are saying that we believe the intrinsic value to be $41.33. When we take a look at the current trading price, we can see it is $1 or $2 shy from that current value. So we believe it is trading near enough its intrinsic value with 0% margin of safety. Now, Wall Street have a price target of $44.50 over the next 12 months. So they also believe the upside is incredibly minimal, and they do not see this as a strong buy. As always, though, do let me know your thoughts in the comments below, whether you hold Intel or whether or not, in fact, you are looking to sell. And as always, if you enjoy the content, smash that like button, hit the subscribe, and as always, I'll see you on the next one.